Hi, welcome to Disruptors. I'm with a very special guest today, someone I've known for a few years. Hannah Chalikowski, how are you?
I'm good. Thank you for having me.
I want to dive into our story, but first of all, kind of get into a little bit of how you came to be. You're in venture capital with a company called Blank Ventures. And for the audience, I'd really like you to describe a little bit about like kind of your journey a little bit. I mean, you're clearly from across the pond, Cambridge, if I'm not mistaken. And talk a little bit about Blank first, a little bit about your history, and then we'll get into it. So welcome.
Nice. Thank you. One of the co-founders of a fund called Blank Ventures based in San Francisco. We have been around for a few years investing out of our first fund, which is a $65 million fund. We focus on pre-seed and seed, fintech and commerce. A lot of venture capitalists will tell you that they fell into venture. And I really did fall into venture. So from Cambridge in the UK, graduated in economics and finance, actually worked for a global oil company in the risk team out of university, managed our European energy position, both the gas and power, helped build out a lot of our risk models for the soda portfolio. And then fast forward a few years, my partner was like, okay, I'm moving to San Francisco. Do you want to move? And while I've studied quite quant-heavy modules, and that's sort of the academic path I went on. I've always been a people person. I think I love spending time with people. It energizes me. And so when I moved to the Bay Area, like a lot of people that move there, I just was sucked in by the startup ecosystem. It's energizing. You can't not be if you're there.
And it's a unique culture out there.
Very unique.
People try to copy it. It's not easy. People think, oh, I just have a lot of money, so I'm going to go into it. I don't think that's the way it works over there.
No.
Very culture driven, very people networking driven. I've learned that.
It's infectious. Like You're around people. And this is one thing that really stood out
Dreamers.
To me compared to the UK. Dreamers. But people genuinely believe they can change the world.
Correct.
And people genuinely do.
I think that's pretty cool.
And so you see people around you that have these, had these huge successes and failures.
Of course.
And it makes you question, like, what do I want to do? What do I feel like I can excel at? And how can I have my mark on the world? And so I fell into venture. I was lucky to join a fund called Initialized early on. It was founded by Gary Tan and Alexis Ohanian. Gary's now the president of YC. Alexis founded Reddit. And straight away, I kind of got immersed into this community inside Silicon Valley of all of these founders and these, ex-entrepreneurs turned VCs. And I really fell in love with the people side of it, and like being there from day zero and hearing people's dreams and hearing, how they view an industry that they want to change, et cetera. And it's just, so infectious that I just decided I wanted to be in VC.
You're in a specific, so for the audience, venture capital is a very, very broad net. And if there's anything I learned about venture capital, everything is being disrupted.
Yep.
And part of this program or this show is a little bit about disruption, and it's kind of a broad brush. But now with technology in the cloud, and especially with AI getting engaged, I feel like the acceleration of that change is happening at a speed that, candidly can create some anxiety for what it's worth. But you're involved in Fintech.
Mm-hmm.
And I find that particularly interesting. Describe, in some ways, why Fintech for you? Out of all the verticals you could, you went from this oil business, quant, and now you're in Fintech. And I'll get into my own thought process on Fintech relative to how the banks are. That's not an easy field to break because of the moat that the banks have. So what got you attracted to that?
Studying economics and finance, and particularly macroeconomics, you really develop this appreciation for how foundational finance is and the economy is to everyone. It impacts everyone around the world. And so we think about fintech, and we had wave one of fintech innovation, which was building a sexy consumer software layer on top of some back-end infrastructure. But really, it's fintech hasn't yet been disrupted to a point that everyone has access to lower cost of capital or intelligence.
By the way, I don't think we're even close to penetrating.
No, we're not.
Which is also the opportunity.
Well, so interestingly enough, S&P 500, I think 3% of that is market cap from fintechs today, and over 13% is financial services. So there's huge upside for disruption and opportunity, but it's so foundational to everyone's life. What drives me is like, if you invest in a company that genuinely, like, so for example, we have a portfolio company that is democratizing access to advisory. And so this is obviously very related to what you do. And if you could just give everyone, small businesses, with the access to information that will help them make smarter decisions, then that genuinely can positively impact their life. And so for me, waking up every day and having that lens of fintech is like deep tech, it really drives me.
Yeah. I've said this more than once. It's less than 13% of clients today are going to follow their older advisor when the great transfer of wealth occurs. It's something like 13 or 14%. I don't really know the number. So then if you take $100 trillion and throw that on top of there, and then women, getting more engaged on the process, I really think advisory is going to be so changed that in 20 years, we won't even remotely recognize it. I this shows you my age, but I often think of the movie Back to the Future when he starts disappearing because, he hasn't caught up with time. I feel like that's happening to the advisors right now. And I think technology is going to be a big part of it. So it's been said, will the advisor be replaced? I think it will be enhanced, but there will be fewer advisors with more information and a greater digital army. And so I think that's why you're seeing this wave of people going into the RIA space, the wave of people doing roll-ups and so on and so forth, because I think they intuitively sense that. How does that play into your fund and kind of how you think about things relative to tailwinds and headwinds?
I think we think about we're in the middle of a tectonic shift with AI. And so for the first time, and I think that this is why financial services is a particularly interesting area to be investing in right now, is for the first time, you have these heavily complex regulated industries and you have contracts. Let's take like loans, for example, automotive loans. You have contracts and the process is very legacy today. For the first time now with AI over OCR, you can start to automate a lot of this process. And so we think about this point in time as like a massive unlock of innovation that has typically been a walled garden. It's been protected, to your point, around the banks. And so I think it's when we're thinking about areas we want to invest, it's why now? What is technology doing to unlock, and do the teams have distribution? That being said, to your point around how do we think about the market now, with AI replacing a lot of the back-end processes, I think it's going to be even more important to have the human that you have a relationship with.
Okay.
Like people will still, there's only so much that tech can do. I think that fundamentally it comes down to trust. And so if you can have advisors with all of this tech in the back end.
Yeah, but what I think AI will do though is truth but verify.
Yes.
So, if the advisor isn't knowledgeable or whatever the case may be, for lack of better words, even not abusing the trust, but just kind of using that as a crutch, AI can pretty much rectify all that because it becomes a fail-safe to the end customer.
But will that just give you a superpower?
Hopefully.
Like a 100x advisor.
Right. Well, I've often said, it's kind of like if you work for a bank, I think one of the main advantages is that you can go to the 5th floor and get some advice on investment banking, go to the 7th floor and get advice on bonds, go to the 3rd floor and get some advice on XYZ. So you have your whole infrastructure, in a headquarters, let's say in New York City, okay? When you have fintech, you have kind of this digital army that is at your fingertips. They don't talk back. They don't ask for raises. They're efficient. They can collect data faster than anybody. So even though the conclusions are the same, I feel that using that type of technology, you can get it faster, cheaper, better. Mm-hmm. And I think that solution ultimately kind of plays in to kind of how this thing is going to evolve. Let's pivot just a little bit on some of the stuff that you're looking at, because I've often wondered, everyone hears all the success stories, Hannah, and you're involved in a lot of the decisions that this particular fund does. And how many investments do you guys have in the fund now currently?
So we have 23 core portfolio investments, and we will invest in 30 to 35 out of the fund. Okay.
And some successful vary, some are okay, maybe some are, a push or a bust, that kind of thing. What do you look for?
I think that we were talking about this. You have the the checklist in terms of like, does this founder have the right domain expertise? Do they have the gravitas to be able to attract talent? Do they have a advantage? And so that could be a distribution advantage or a tech advantage, whatever that might be, that gives them a comparative advantage over other players in the space. So I think we're looking for those hard skills, if you like. But I think if you peel that a layer deeper, it's like building a company and starting from zero is really hard. And you do see the headlines, like, there's no such thing as an overnight success. But it's like, what gets a founder to that point is grit and determination. So there will be, you'll have differences of opinions on the team, on which direction to go in. There'll be strategic decisions that need to be made that will make or break a company. And so do these teams have the grit that when they are faced with, closed doors time and time again and no, that they can find a way through? And I think that's what we really look for.
I'll tell you something is a kind of a headwind in the business that I've noticed is ego.
Yes.
So you get a particular individual, man, woman, doesn't really matter. They actually show a zero balance. They get a little bit of money. They show success. AR jumps, 10-fold, 15, 20-fold. And before you know it, they think they're Elon Musk. And do you find that plays into the detriment of their growth long term? Because then all of a sudden they're like, well, we're a unicorn. It just seems like that's, how do you manage that expectation? How do you manage that ego? It's like a superstar football player, and they're just out of college and all of a sudden, on the big stage and they make 6 catches and they think, they're going to the Hall of Fame. How do you manage that?
I think it's more of an art than a science, because it depends on each individual character and like really understanding what, how you can get through to them and like what will resonate with them. And I think it comes from just building trust and being one of the trusted partners in the inner circle. And because we're investing so early, we're in the inner circle before some of these successes happen. But,
so they hopefully view you as a partner as opposed to a foe.
That's the intention. But look, I've seen this before, like with 2021 and now with the AI boom. We saw a phase where a lot of capital was going into companies. All of a sudden, companies that weren't Series A ready were raising $40 million Series A rounds. And for a moment, everyone was following the, blitz scaling mentality, which is like, let's just throw dollars at growth and try and grow as quick as possible. Definitely that's out of vogue now. I think you're seeing the lean AI startups. So companies are getting from, 0 to 100 million in revenue with less than 20 people. Yeah. And so now a lot of founders are aspiring to be like that. We want to be a lean team. We can do so much more now with less because of AI and how it can give these early teams and the early engineers leverage. But I think it's just being a thought partner to them and being on the inside. And you can only try and warm them. Some people, they have to learn their own way.
I'm kind of laughing because I listen to about 30% of what you say, and because of your accent, I believe everything you say. So for what it's worth, I'm sure you have a lot of credibility, but the accent definitely carries. It's just a little thing for the audience. You're from the UK, you're from Cambridge, okay? Venture capitalism in the UK. We hear about it all the time. Cultures, US, totally different, more... It's definitely a louder culture.
Yes.
Is venture capital the same in the UK as it is in the United States? I mean, the way they approach it, can you give me some insight there? I mean, technically, there's other. This is how naive I am. I know the United States very, very well. I know there's venture capital everywhere, but it just seems like more venture capital emanates out of the United States than everywhere. Now, that could just because we're just louder. I mean, because you're from the UK and now you're in the United States, especially in the epicenter of venture capital. What's the difference?
So I think there's 2 key differences. One, structurally.
So there is a difference.
Oh, 100%. And it's something that really stood out to me when I first moved to San Francisco. Structurally, in the UK, pension funds don't invest in venture. So in terms of pools of capital, there is just less in terms of the sheer volume of capital going to venture funds and therefore startups. So that's just something to bear in mind. The second piece is the US is far more risk on. And so early stage funds, corporates are willing to take a risk on partnering with early stage startups. In the UK, we see, and a lot of and it is changing, but typically a lot of VCs or general partners have been ex-consultants. And so you're pre-seed, seed stage company, and they'll ask for, 5-year cash flow forecast. Well, we don't even know what the product will be really in 2 years' time. So how can we give you a 5-year forecast?
Don't then the Europeans feel that they're falling behind? Or do they care?
That is a very good question.
I mean, if you think about it, because I want to I didn't mean to interrupt you, but, everyone asks, is AI in a bubble? And I think that's a very fair question. But when you see these major countries throwing literally trillions of dollars into it, my only reasonable answer is, I don't know if we're in a bubble or not, okay? But I do know the consequences of not winning are gigantic.
Yes.
And so it kind of, I view it a little bit more, and not to bring any type of, connotation to it, but almost like an arms race. I mean, we in this world, we have more than enough nuclear weapons to obliterate the world, so to speak. And so I'm assuming we're going to have more than enough AI. But the cost of losing is so high that if we lose, everyone kind of intuitively feels that if they don't control their own domain, they're going to lose out in the global economic war. Do you feel that it's that dramatic?
Absolutely. But the challenge is, and the UK needs to do a better job at keeping great talent, because what you see, and we actually invested in a UK-based founder last year, and the founder tried to raise his pre-seed round in the UK, and I wouldn't say struggled, but it was a hard process. He ended up coming to San Francisco. He raised his round in 10 days, a week. We were an investor there. He then moved the entire team to San Francisco a few weeks later. 4 months later, he had early customers, early momentum. He raised $5 million follow-on funding. And the last I heard, the company's doing incredibly well. It wants to end the year at close to $5 million in revenue. So 0 to 5 in 12 months is amazing. Yeah. Would he have been able to achieve that in the UK? A, the funding wasn't there. B, is there the appetite on the demand side to actually get to that revenue? And C, is the talent there, the density of talent that he can find in San Francisco that will enable them to execute? So the UK and Europe really needs to try to keep that talent. Otherwise, they're just going to lose it to the US.
Yeah, the thing that I think is pretty cool is, and I've said this more than once, everyone just thinks the Bay Area is X and we can just bring a lot of money. It's really not the case. There is a genuine culture there. You have to put the time and the energy, the meetings, and so on and so forth. And I got to figure that's somewhat similar to the way people feel about the Middle East. When you get the UAE and Dubai and Qatar and all these big sovereign nations, GIC and so on and so forth, people think they can just bring their idea there. Oh, you got billions of dollars and give us the money. No, that's not the case. I think you have to spend the time, understand the culture, and understand the people.
It's a mindset. Like I always say, Silicon Valley is a mindset, but you need to be surrounded by people that also have that mindset to be able to succeed.
I've got a question about the banks, Hannah, because I worked for banks. I have a great history with banks. I think they're terrific, but they're resistant, kind of resistant to change. And yet I feel like there's this Hoover Dam starting to build, where it's here and then there's nothing over here. What do you think breaks that dam in the fintech industry? What do you think what's the holy grail? What do you think everybody, because there are other fintech funds trying to break through. First it was in the payments area, but now it's starting to get more granular. Do you feel like the real question is, do you feel like the banks are accepting of the fintech move, or do you think that they are politely rejecting the technology because they recognize by doing so they're accepting change?
I think they're resistant to change.
I do too.
And there's a lot of bureaucracy. They're very slow to adapt. But I think fundamentally, at some point, they're going to have to wake up to the fact that consumers want something else.
Well, and if I may say something, what's really screwed up? So every bank, they control trillions of dollars, right? Market goes up 10%. Why should they change, right? They just went from $2 trillion to $2.2 trillion, and the fees that they collect from that is just so astronomical. Yep. So even if you have, companies that are doing 401ks or so on and so forth, even the Robin Hoods or the Betterments of the world, so on and so forth, terrific success stories, they're only just taking a smidgen of the pie. So do you think the bank just say, it's nothing, it's just a speck? What's the big idea out there? I don't know if I have the idea. I'm just saying, do you it's so big.
I think that's the wrong way to think about it initially, though. I think we have to think about what's the thin edge of the wedge that will get adoption.
Right, boom.
And you then slowly can build momentum and power and then start to rebundle the products. I think that's the only way. But the big idea really is decentralization, digital money. How do you actually, start to take some of the control away from these big entities? And so you have the proliferation of decentralized money and stables, and we're seeing a lot of innovation there. We're seeing Base partner with Stripe, and we're seeing big movements of powerful fintechs. The biggest question is how do you actually roll this out? We're seeing international remittances seeing huge adoption, and I think it was 33 trillion of stablecoin volume. There's $300 billion in market cap. But then the question is how do you actually scale this internationally? There's different local laws in jurisdictions on what's the on ramps and off ramps of stables, etc. So a lot needs to be done for this to really start to change the way the financial system runs. My view is that it will just slowly proliferate. So as cash started to become, a smaller piece of how cash was exchanged or currency was exchanged in an economy, and then it's, cards, I think that's what we see with digital money.
Yeah, and I will tell you, I recently saw some news of a company that I actually do some business with that just pulled $100 billion team from a bank, and more in corporate services. 20 years ago, that was unheard of, because if you're in corporate services, you're at a bank. So I think the first iteration of that change is the fact that so many of these bank advisors are moving into the independent space. That's iteration number one. But after they get off the glory, the glow, so to speak, of, I'm independent, I've got my own, 1099, so to speak, they have to be a differentiator. So I think the second iteration of technology is coming, where they're actually going to look for that flywheel. If there's anything that I see as a little bit of an impediment, is you have a lot of bright engineers and software engineers and so on and so forth, programmers, but they're only specifically entertaining that particular vertical. And so even though it fits into the overall scheme, the advisor pretty much goes, hey, look, that's just more stuff I got to deal with on my flywheel. So I think someone's going to aggregate this at a point in time and decentralize it.
Yep.
So, for example, if the banks are using the internet, the bad guys are there too. Cybersecurity is there. So decentralization, I think, will become a very critical factor. I don't know when that time's coming, but I do feel that Hoover Dam breakage coming. Pivot a little bit, because we're coming near to a close, and I want you to impart some wisdom. What advice would you give to a founder who has this bright idea and is about to pitch a venture capitalist like you, or anybody else for that matter? I was at TechCrunch giving advice to some of the founders, and the line was a mile long. And I had my specific ideas, but if you were looking at somebody who quite isn't as well organized as they should be, but has potential, what's some of the advice what is a common mistake some of these founders are making when they pitch you?
Not thinking big enough would be one piece of advice. Think big, and then let's work backwards from the end goal, and how do we get there? That would be one. The second is outsource what isn't critical or core to your business. So to the point I'm marrying in the financial advisory piece, how do you make sure you have the systems in place that enables you to just focus on the business and just focus on scaling that? I think oftentimes founders try to do things that aren't in the best interest of the company, whether it's managing payroll or whatever it might be. I think it's really important to try and outsource that to focus early on. But think big and focus on execution and what matters, what really moves the needle to the business. I've only seen founders fail by trying to do too much. I haven't seen founders fail by not doing enough and focusing.
And there's a definitive line between there.
I guess I would flip that question to you on what do you see from some of the clients that you've worked with, and even some of the earlier stage startups? What should founders be thinking about early on as they do think about, building wealth and the success? What should they be putting in place early on, or when should they be engaging?
What do you mean? The client?
With the client with a keyback, or with Bruce?
It's for what I think it is, it all depends on the type of client and the age of the client that you're going after. So from my experience, if you're not going after, but if you're, cultivating a a larger relationship, but the individual is more patriarchal in nature, older, okay? They're going to want more standard, where would you educated? What bank do you work for? How do you keep me in the safe zone? What they're not recognizing that in a very short period of time when they want to pass their legacy over, the kids aren't thinking about that at all. And so, selfishly as a firm, what we're focusing on really is the next gen. We're not focusing on the next 5 years. We're focusing on the next 30. And, when we're thinking about how big something needs to be, I'm not necessarily interested in picking up a few $1 billion in assets. I'm more interested in the 100 billion or the 100 trillion that's about to transfer over, of which, if you think about the astounding number of only 13% is going to go with their old advisor, I don't want to be part of that 13%. I want to be part of the 64.5% that's going to be switching to something. So if we don't change now, we're screwed, in my particular opinion. So that's where I think fintech is aligned with the things that we're working on and how to think really big about it. Hannah, I just wanted to let you know that I, first of all, appreciate you visiting Las Vegas. It's not someplace
Thank you for having me.
But you've got other conferences here that you're going to come.
Yes.
And we'd love to have you back on the show again to talk about some of the portfolio companies, success or not success,
Yes.
so that we can learn from it.
And we'll get some founders on the show.
That'd be terrific.
Yeah.
All right. Well, thanks so much, and we'll see you soon.
Thank you so much.